Okay, good afternoon, everybody, and thank you for joining this InvestEngine webinar in partnership with JP Morgan Asset Management. I'm Andy Prosser, I'm the Head of Investments at InvestEngine, and I'm joined today by Ruairidh, who's an investment specialist at JP Morgan, and Ted Malcolm, who is the Head of UK ETF distribution, also at JP Morgan. Now, in terms of the plan for the webinar, it's going to be a bit of a Q&A. So I've got a few questions which I think people will likely want to know the answers to, so we'll start off with a few of those. But I'm also going to be picking questions from the Q&A as well for the end. So if you do want to ask questions as we're going through the webinar, you can click on, there should be a small kind of Q&A button at the bottom of your screen. The questions won't get broadcast to the whole webinar chat. They'll just come straight to us. So don't worry if you think you've got a stupid question, absolutely fine. Just ask away and we'll answer as many as we can at the end. Now, it's my job to make sure that everything runs on time. So I need to make sure that I leave enough time at the end, probably kind of 5 minutes-ish, for a quick demo of how to buy these ETFs on the InvestEngine platform. So I'm hoping that once we've wrapped everything up, we'll be ending the webinar at about 5:45. Now, before we get going, I do need to mention on the next slide the usual disclaimer that your capital is at risk whenever you invest. This webinar is for UK clients only and that none of this is financial advice. One final thing I think to note is that this webinar will be being recorded. We always get questions on this, but yes, this webinar is recorded and it will be uploaded to YouTube in the coming days. Okay, so without further ado, let's get going with the first question then. And I think this is going to be one for you, Ted. Can you just give us a bit of an introduction to start us off to what active ETFs are, and then maybe go through why they're growing so quickly?
Sure. Thanks, Andy, and thank you to those of you logged in this evening. So yeah, active ETFs, it's still pretty new concept to the financial industry. They started sort of coming to emerge to the market about 10 years ago. And if you think about historically what ETFs have been, they've predominantly been passive investments. So 30 years ago, when the first ETF was launched, they very much were just about tracking an index. So the investment objective of a passive ETF is to replicate the relevant index. So if you've got an S&P 500 passive ETF, they should be giving you the return of the S&P 500 if they're doing their job properly. Now, obviously with active management, which has been around for centuries, the aim and the investment objective of active management is to deliver over the long term excess return above and beyond that benchmark. And you can do that in all sorts of different ways, use all sorts of different routes to try and deliver that excess return. And so what we're doing now is historically active management used to be in various structures such as mutual funds and investment trusts, which they still are today. But now, with the likes of ourselves at JP Morgan and a few other managers, we're now starting to also deliver our active investment capabilities via the ETF. So it is no longer just pure passive ETFs, there are now active ETFs. And as I said, the aim of those active ETFs is to, over the longer term, to deliver excess return by hopefully picking the winners over the losers using all sorts of different research frameworks to deliver that return. Now, to your sort of second question in terms of why are they seeing so much interest? If you look at this slide in front of you, this talks to, I suppose, the benefits that come with both active management and obviously the vehicle. Now, I've touched on the active management bit on the left-hand side, hopefully delivering that excess return and good risk management in volatile markets. But actually, if you couple that with the benefits that come with the ETF vehicle, totally separate from the investment piece, things such as attractive fees, very transparent. So you can see, even though it's an active strategy, you can see exactly what our portfolio managers are doing on a daily basis. Very easy to access, so you can go on the InvestEngine platform and really get very easy access and tradability of these ETFs. You pair those two things together, it becomes very attractive to all sorts of types of investors, whether retail investors or large institutional investors. And in terms of kind of the demand that we're seeing, if we flick through to the next slide, please. What we're seeing is, as I said at the start, still a very small market. So it's still a 92% passive market, ETF land. So active ETFs make up about 8%. But actually, if you look at the flows this year, 30% of all flow going into ETFs is now going into active ETFs, coming from that lower 8% base. So really, investors are beginning to embrace the fact that they can now access high quality active strategies via the ETF vehicle. And the other thing to note, if we turn to the next slide, is that obviously these markets take time to mature, but we at JP Morgan plus other asset managers are launching a lot of active ETFs. So when you go on your InvestEngine platform, you're going to have a whole lot of choice on passive, but increasingly so you're going to have good choice to select different active strategies. And that's important because you want to make sure you're partnering with the best active managers in their particular asset classes. But there is great choice now. And this slide here just shows the number of ETFs that have been launched. And you can see in that green section on the left-hand side, the steady increase in active ETFs being launched. In the US this year alone, the top right of this chart illustrates this, over 85% of all the launches this year have been active ETF launches. And so back to my point, all this means is you as investors now have got such a great opportunity to be able to select obviously lots of passive ETFs for that pure beta exposure, but where you believe a manager might have an edge and you have the ability and resources to actually add alpha excess return above the benchmark, you can then partner with them and select the actively managed ETF. And so we're really starting to see that ramp up.
Thank you very much, Ted. That's a super impressive growth story. Next question is probably one for you, Ruairidh. Could you explain a bit about JP Morgan's REI ETFs, what they are, how they work, and then maybe kind of focus on how global diversification can help investors' portfolios compared to just kind of investing in a single country like the US?
Yep, absolutely. Thanks, Andy. Great to be here. Yeah, go to the next slide, please. As Ted has just mentioned, active ETFs have been a huge sort of growth story in Europe. We launched the REI active ETF range in 2018, so almost 7 years ago now. But these strategies have actually existed for a really long time at JP Morgan. They date back to the late 80s in the US, and we've been managing the global REI strategy since the early 2000s. And historically, these sorts of strategies really were for big institutional investors. So think of pension funds and big corporates like, let's say, Tesco or Sainsbury's, the pension funds there. Really, these products were reserved for clients like that who gave us very large sums of money and access to these sort of bespoke strategies. But as mentioned, what's been really exciting for us at JP Morgan is to package what was an institutional strategy into an ETF wrapper in 2018 and really open it up to a whole new spectrum of clients, including us personally as well. Now, these strategies sit within our researched enhanced index suite of products. And enhanced index, as mentioned, has been around for a long time, and there's lots of other people that do enhanced index strategies as well. If you've not heard, enhanced index before, then the graph on the right-hand side, I think, is a really good illustration of what enhanced index is trying to do. So if you look at the sort of green square, that's your traditional passive fund. So your passive fund is trying to track the benchmark or the index as closely as it can. And if you move up that sort of blue dotted line towards your traditional active manager, so think, maybe a fund that is investing in, 70 or 100 stocks, so best ideas. A way to measure how different they are from the benchmark is tracking error. And as you can see, to try and generate higher levels of excess return, you've got to take higher levels of tracking error or higher levels of risk. So up that blue dotted line to the traditional active manager, if you want to get much better return, you've got to be super different. You've got to take a lot more risk versus the benchmark. Now, what enhanced index seeks to do, as you can see here, is generate positive excess return. So it's an actively managed product. We want to beat the benchmark, but at a much lower level of excess return than you might expect from a traditional active manager, but also with much lower levels of risk versus a traditional active manager. So in essence, what enhanced index strategies are trying to do is they're trying to look feel, behave like passive indices, but take very low levels of sort of risk, the tracking error, to try and beat the benchmark. So enhanced index strategies, in the global space, typically have 600 to 700 stocks in their portfolio, so they're really well diversified. Now, when enhanced index really works, when we get it right, we're using active management, like I said, to try and beat the benchmark. And how we do it at JP Morgan is to use research, and that's where research enhanced index comes in. And we can talk about this in a few slides time, but this sort of high level overview of what we're doing is we are using the insights from our team of fundamental sort of stock analysts around the world to make very small over and underweight decisions at the stock level. So if we like a stock, we'll own a little bit more of it. And if we really hate a stock, we don't like a stock, we'll own a little bit less of it. So the idea is we use the insights from our team to make small over and underweight decisions at a stock level. So ultimately, this portfolio is driven by bottom-up fundamental research. And if you go to the next slide, you can see how these strategies have performed since we launched them in 2018. And I think, this slide does a really good job at illustrating what these strategies are trying to do. So you've got the products in blue here and their benchmarks in yellow. So top left, we've got global, top right, we've got Europe, bottom left, we've got US, and bottom right, we've got Eurozone, which is basically Europe excluding the UK. And you can see in basically all of these instances, the product in blue looks very, very similar to the benchmark or passive in yellow. And if you just focus your attention to the top left for a moment, you'll see that at the outset of this product, when we launched it in 2018, there's very little difference between the blue and the yellow line, right? You can barely see any difference at all. And that's good. That's what these products are designed to do. They look to behave very similar to the benchmark. But over time, all that work we're doing on the fundamental research, the overweighting and the underweighting of stocks, trying to generate, a little bit of excess return, should compound into quite a meaningful difference versus the benchmark over time. So where you look today, there's quite a nice difference between the product in blue and the benchmark in yellow. Now, all of the numbers that you can see here are annualized. So if you'd invested in the global product JREG in 2018, you would have seen 0.69% annualized excess return above the benchmark. And I think that's, a really powerful outcome for a lot of investors. Now, to sort of tackle the second question you had was, how do we think about diversification? Should we go for one region or one sector? Again, I think this slide is really interesting to look at. So you can see, just how the different indices have performed since 2018. So bottom left, the US, up almost 140% since 2018. Europe on the top right, the scale is slightly different here, but about 80%. So really, quite differing fortunes depending on if you've gone for global or when you've gone, or if you've gone for US or if you've gone for Europe. However, if you look at top left, global, sitting somewhere nicely in the middle, and I think particularly at the juncture we're at now, where there's a lot of uncertainty about the US economy, a lot of optimism about the European economy, and valuations on equities, really differing in different regions. I think going global really allows you to sort of spread out your risk across as many different regions and sectors as possible, and really gives you the best sort of diversification. So in our business, we're seeing a lot of investors looking to go global at this point in time.
Yeah, I think you're absolutely right. And that's the trend that we're seeing at InvestEngine as well. I think this slide does a really good job kind of showing how these ETFs are designed to behave, as you talked about, kind of low tracking error with consistent incremental outperformance. But can you maybe talk a little bit about how the actual portfolio construction process works? Who's putting these ETFs together, and what do the underlying portfolios actually look like?
Yeah, absolutely. So, next slide, on slide 11, clearly research is the key word in what we're doing here. And on this slide, you can see our team of bottom-up fundamental sort of equity analysts. Globally, we have just over 80 of these analysts around the world. Collectively, they cover 2,500 companies globally. So, if it's big and worth covering, we cover it essentially. And we spend $150 million a year on this research team. So, big numbers. But really, this team is, so crucial to everything we do at JP Morgan, sort of asset management. So within our equity division at the firm, we manage just over $1 trillion in assets globally. And this team of fundamental research analysts basically underpin absolutely everything we do. And on the right-hand side, you can see the heads of research. So Mark is the head of global research, and underneath him, you can see the heads of research for the different regional teams. Now, I just want to focus on Mark for a second, because I think he's a really good sort of illustration of what many of the analysts are like at JP Morgan. So you can see next to his name, there's two numbers, 26. The first number is years of experience in the industry. So he's had 26 years in financial markets. And the second number is years of experience at JP Morgan being a research analyst. So he spent his entire career being a research analyst at JP Morgan. I think a lot of people might find that boring, but a lot of our analysts, are so passionate about research. On average, our analysts have got over 20 years experience in the industry and well over 10 years experience being research analysts. So, these are really senior men and women, again, based around the world, doing really in-depth fundamental stock research. And we're tapping into the insights of this team to make underweight and overweight decisions. Again, as I said, at a stock level. Now, if we go to the next slide, picture paints 1,000 words. And I think this is, again, really good illustration of what it is we're trying to do. So the portfolio managers we have on these strategies, again, very similar to the research analysts, decades of experience at JP Morgan managing these portfolios. And it's their job to ensure that the portfolio is doing everything that we've outlined so far. They look like the index, they behave like the index, and all of the risk budget, the tracking error that we're using, comes from bottom-up stock insights. And here is the global product. So global product in blue and benchmark in yellow. Very similar weights on a regional basis. So investing in passive or investing in this product, you get very similar exposure in the US, in Europe, Japan, and likewise very similar exposure on a sector basis as well. It's only when you get to the very far right-hand side, you can see where the sort of differences versus the benchmark come in. So this is the European retail sector as an example, and you can see we're overweight names like Tesco and Next, because they're names that our analysts like the most, and we're underweight names like Hermes, which is a sort of luxury fashion designer, and Kering as well, which again is sort of similar luxury fashion goods. So we're making lots of sort of individual stock decisions in every sector, in every region across the world. And that's why, the returns that we showed you at the outset have been so consistent and so attractive over, quite a long period of time. And maybe finally on the next slide, obviously we've spoken a lot about going global, and global is a great way to sort of diversify, but we do have lots of other products in this sort of suite of REI sort of strategies. And I know that we have a couple of these on the InvestEngine platform, right?
We do. Let me just jump in here. Yeah. So we have 4 flavors of REI on the InvestEngine platform. We have the global REI and the ticker. It's probably best to ignore the tickers on the slide because we only have on InvestEngine the sterling lines of these ETFs. So the global REI, we have the ticker is JGRE. We have the European REI and the ticker for that is JERE. We have the US REI, which is JURE, and then emerging markets is JMRE. So I'll repeat all those at the end, kind of during the demo, because that's quite a lot of information to take in. But we have global, Europe, US, and emerging markets. It's quite easy to search on the platform. You can search by research enhanced, and that will bring up all the REI ETFs. But in terms of the tickers, I'll go through those when I do the product demo at the end. Yes, back to you, Rory.
Perfect. Yeah. So just to sort of reiterate there, all of these tickers that you can see here, all of these REI strategies are managed in the same way, so same philosophy, same sort of process. Next slide just shows you the global strategy right now versus its benchmark, MSCI World. So again, this just brings together everything we've spoken about so far. Really, these products are designed to sort of look and feel like the benchmark. So the blue bars that you can see on the left-hand side are for sectors and on the right-hand side are for regions. Very, very, very little difference versus our product, JREG, versus the benchmark. You can see, going global, you still get, a lot of access to the US. So if you look on the right-hand side, North America, just over 75% of global markets now is the US or North America. It's a pretty startling fact. You still get, some really great exposure to Europe as well. So about 16% of the portfolio will be Europe, and the remainder, call it 7%, will be Asia.
And speaking of the US, maybe we can have a look now at each of the kind of regions individually, if that's okay. Do you think there are opportunities for investors outside the US at the moment?
Yeah, absolutely. Really, really interesting time to be talking about equities right now. If we jump on to the next slide, on slide 15, we can see, some valuations of markets around the world. Now, this comes from our guide to the markets, which is published on our JP Morgan website. It's a really, really great resource, I think, for lots of sort of stats and sort of sound bites on what's going on in markets. I think what's been really surprising is just the sort of bounce back that we've had from so-called Liberation Day, which is when the tariffs were announced by the US administration in sort of the first week of April. Markets have really bounced back pretty hard since then. And it's left valuations around the world, looking either in line or pretty expensive. And if you see the left-hand side, this is plotting global PE ratios, so a good metric for valuation of equity markets for different regions. And you can see, sort of world, so global markets, above their long-term averages since 1990. So, a decent amount of history there. And then if you break that down into different regions, you can see the US really, quite expensive now. So trading quite above its long-term averages. And the gray bars that you can see here is basically the range. So it really is trading up towards, the sort of higher end of its valuation range. And that's obviously causing a lot of people to really start to think about valuations within equities. And of course, a lot of people, are trying to look for cheap valuations. And one place where you can get that, or cheaper, is in Europe. Just sort of in line with long run averages. And then if you look at areas like the UK or emerging markets or China, you can get that part of the market for cheaper than its long run averages. And I think the chart on the right hand side is really quite interesting. So this is showing the relative valuation between US markets and European markets. And the purple line is Europe ex-UK. And you can see, it's basically 30% discount to Europe right now. And the blue line is the UK. So the UK is trading at over a 40% discount versus the US. So we've seen, a lot of investors really start to look into Europe as well to try and take advantage of these cheaper valuations. And of course, Europe has been one of the best performing regions so far this year globally. And of course, a lot of that has come from a revitalization of the European economy. So lots of countries around Europe are starting to spend. A lot of fiscal spending is coming back. Again, the valuation is a key part of that. And underlying, the European consumer and European businesses are doing pretty well. So, I think, within global markets, Europe is really interesting right now for investors.
And what about the US then? We all know that the kind of large technology stocks, the Magnificent Seven, they've been kind of driving returns for the last few years. But does that mean investors should be avoiding the US? Just kind of keen to hear your thoughts on that.
Yeah, it's a great question. And you might think that, right, when you see the chart here of just how expensive, the US is versus the rest of the market and versus its own history. But if you were to have been underweight the US, over the last couple of years, I think you really would have struggled. And if you go to the next slide, slide 16, you can see why. The US, despite being an expensive market, still has some of the best, most exciting companies in the world. Everyone now knows about the Magnificent Seven. You can see in the footnote what those companies are, but Apple, Amazon, Google, Meta, which own Facebook, Nvidia, and Tesla. And I'm sure many of the people dialed in might hold them directly. And you can see on the left-hand side just the performance of this group of companies. So we've split out the US market, so the S&P 500 in grey. We split that out into the Magnificent Seven in green, and the US market excluding the Magnificent Seven in blue. And really, the Mag 7 has done an incredible job. They really, really have delivered outsized returns. And if you look to the top right, the reason for that is earnings growth for this group of companies has been really, really, really strong. So earnings growth for the Mag 7 is in green in the top right, and for the US market, excluding the Mag 7, is in blue. So really, really strong earnings growth. However, what's interesting to note is particularly if you look at 2023 and 2024, when really the Mag 7 was absolutely trouncing the rest of the market in terms of earnings growth. As we look to this year and next year, expectations are for earnings growth between Mag 7 and the rest of the market to narrow. So really, we're expecting the rest of the market in the US to sort of play catch up in earnings. And I think from here, that's probably going to be a really important driver of the US markets. And because the Mag 7 has done phenomenally well, they've delivered a lot of earnings growth, but they're quite expensive right now. And I think they're contributing a lot to what we saw on that previous slide as to why US markets look so expensive. And the final thing I'll say here is just on the bottom right. The Mag 7 as a group has been a great place to be, but look at the distribution and outcomes from the Magnificent Seven stocks. So particularly 2023, right, where it's most pronounced. The best stock in the Mag 7 was up almost 240%. The worst stock, quote unquote worst, was up only 50%. So this says to us, there's huge value for active management, and particularly year to date. Year to date, this group has done really well. Best stock up 32%, but the worst stock down 24%. So, there's a lot that active can do, in this group, to try and deliver some alpha. Within our REI portfolios, we're actually, overweight a number of these companies. So we're overweight Meta, and we're overweight Microsoft, these are some of the companies in the Mag 7 that we like the most. And we're underweight names like Tesla and Google, although the parent company is Alphabet. They're companies where on a longer term basis, we think the outlook for those companies are a little bit more challenged. So, in REI, you still get access to these really exciting ideas, but we're using, bottom up fundamental research to try and make your money work a little bit harder and give you, some excess return on top of that.
That makes a lot of sense. Thank you, Rory. Thank you, Ted. Really interesting stuff as always. That brings us to the end of the kind of presentation bit of the webinar. So we're moving towards the end now, just a bit conscious of time as well. So I will do a quick demo to show how to buy the JP Morgan ETFs on InvestEngine. But just in the meantime, please do feel free, keep those questions coming. I can see we've had a few coming already. If we don't get a chance to answer them today, we'll do our best to get back to you after the webinar. So here we've got a dummy account to walk through. This is the InvestEngine platform, obviously. So once you're logged into InvestEngine, either on your app on your phone or on the web browser, you can either select a new portfolio or you can select an existing one. I've got this DIY one, very imaginatively named portfolio that I use for demos, so I will load that one up. It has a 50-50 split, you'll see, of equities and bonds. You can see it's up about 23%. 50-50 equities and bonds. And if I want to add a new ETF into my portfolio, all I would do, it's a very simple process. You just go through, you add securities, and then you click the nice big JP Morgan Asset Management banner at the top here, or the tile at the top here. And we've been talking about the REI ETFs today. Sorry, I apologize if you can hear a siren in the background. Now, I'll read out those tickers again because I mentioned them earlier in the webinar, but again, it was probably quite quick. So we have 4 REI ETFs on the platform. So we can search for Research Enhanced, and that should bring up all of them. But the 4 ones I was mentioning earlier, we have the Global REI, which is JGRE, which should be down here somewhere. JGRE, there it is, down the bottom. That's the global one. We have the European REI, which is JERE, which we should also have in this list here. Yeah, there it is. And we have the US REI, which is JURE, just up here. And we have the emerging markets, which is JMRE at the top here. So I'll select the US one to add to the portfolio. You can see it brings up a performance chart of how it's done. And if you go down here, you can find out more information about the ETF, the fund size of the TER and whether it's accumulating or distributing, and a bit of a description as to what the ETF does and who the issuer is. So let's say we want to add that to our portfolio. We just very simply click Add to Portfolio. And you can see in the top right here, this little box that has now been added to the list of ETFs in the portfolio. Now, the next screen, here we go. This is where we select how much we actually want to invest in the ETF. So let's say we want to take out our old equity ETF entirely and we want to put it all in this one. And take that one out, and then we will review and continue. Now, this is an interesting screen. It shows you how that switch would affect your portfolio. So you can see here that in the kind of grayed out number, that's what the existing target weight in your portfolio is. So North America was about 30% of the portfolio. And then after this change, it would increase to about 47%, which makes sense because we're removing a global tracker and we're putting a US REI ETF in there. So it'd be an increase to the US and a decrease to Europe, decrease to UK. That all makes sense. You can see how it affects the sectors as well. We'd be seeing an increase in technology, very much what we'd expect, an increase in industrials, slight decrease in financials, et cetera, down to the individual holdings. And we were talking about the Magnificent Seven before. We can see that making this switch, you'd have a much higher allocation to NVIDIA, Microsoft, Apple, Amazon, Meta, all the big tech names we were mentioning before. So we'd save and continue, and nice big green tick, very good. If we scroll down here, we can now see that the JURE has a 0% current weight here and a 50% target weight. So it hasn't automatically updated the investment. What you need to do then is go into options and then just click rebalance portfolio, and that will rebalance to your target weights. You can also, if you want to invest another kind of one-off lump sum into the portfolio, you'd be clicking this button here. If you want to set up a kind of more regular investing plan into your portfolio, you can just set up a savings plan here, and that'll take you through if you want to set up a kind of 100, 250, 500 quid a month into your portfolio. So it really is a very straightforward process. And with that, I will stop sharing my screen. There we go. And we've got a few minutes now, 10 minutes or so, to go through some questions. So let's have a look and see what we've got. Right, okay. I will start with the first question then. I'm not sure who's best placed to take this one. I'll ask it to both of you. What sort of investor would these ETFs appeal to? Is there any individual client type that these are more suited for, or are they suitable for any investor?
Yeah, I mean, as we outlined at the start, they started off, very much as an institutional product. So as Rory said, those big pension funds, sovereign wealth funds, but with the advent and the launch of these ETFs, they are now available to everybody. And that's the beauty of the ETF vehicle, as you all know. And so therefore we see retail clients using these products, we see wealth managers, advisors, and of course, institutional investors as well. So a really broad remit, sometimes using them in different ways, but very much accessible to all types of investors.
Yeah, and just on that point then, how do you think they should be used in a portfolio? How do you see your clients using these in portfolios? Do they kind of replace your core ETF exposure, or are they used more as kind of satellite positions?
Yeah, good question. So these are very much core solutions. So they have often been used as a replacement for passive for those investors who believe that active management can deliver excess return that we have done with these REI ETFs. And so they replace a passive because they're similarly priced and give you that core exposure to a market. They definitely should be used for long-term investing. Generally, active investing should always be long-term investing. And so, yeah, these are not tactical kind of satellite positions, but more core traditional.
Yeah, that makes sense. We've had one question come in about currency. That's obviously been a big factor in returns this year. How can currency fluctuations, particularly between the dollar and sterling, affect the returns for UK-based investors who invest in these ETFs?
Yeah, so the big thing to think about, particularly if you're investing in the US REI ETF or the global REI ETF, really big parts of what you're investing in is going to be US dollar assets. And if the US dollar weakens and the pound gets stronger, that's going to impact the return that we get as sort of pound investors. So that is one thing to be mindful of, is that you might have the US market going up, but if the US dollar is weakening and the pound's getting stronger, that's going to mean the dollars that you have are going to be worth less in pounds. So your pound return could be impacted by that. But that's a very important consideration to think about when investing internationally.
And one thing I'd add to that, though, is for the global REI, we offer a sterling hedged share class. I'm not sure if that's on the InvestEngine platform, but that then eliminates that currency risk for you as a sterling investor.
Yeah, we can check that after this, and if it's not, then we can get it added in the next couple of days. Right, next question then. Rory, I think one from you. This is about the kind of stock selection process. You were talking about that huge team of analysts that all feed into the research process for this, but how do they actually select the stocks that go into portfolios? Is it purely quantitative or is it qualitative as well?
Yeah, it's a great question. So it's all sort of fundamental. So it's all qualitative. So really what these analysts are doing is they're tasked with researching a handful of companies. So it's typically about 25 to 30 stocks each. And they're doing really, really long-term forecasts. So they're looking 3, 4, 5 years from now, what can a company earn? So, if you take let's take an example of Apple. Everyone knows Apple. What a lot of market participants will be doing is they'll be thinking, how many iPhones are Apple going to sell this quarter? How many are they going to sell next quarter? Which is hard enough, right? But what our analysts are doing is they're trying to think 5 years from now, what is Apple going to look like? What's the company going to look like? Is there going to be a new iPhone device? Are we going to have some AI device instead? And is the services business going to be a much greater part of what Apple do? So, the cloud storage, Apple Music, Apple TV. So they're looking really, really far out. And they're doing that for all of the companies they cover. I've sort of alluded to it. It sounds hard. It is really hard, and we certainly don't get it right all the time. But we think we get it more often. We get it right more often than not. And you saw, the experience of our research analysts, the resources we have, the amount of money we put into research. We really think we've got a world-class, if not world-leading research team. So they're forecasting, out much further than the rest of the market, and we're making investment decisions on that basis. So if we buy a stock, it's because we think it's long-term. The long-term expectations for this are not being currently reflected in the share price. So it's very, very, very quantitative in nature. It's sort of bottom up, boots on the ground, sort of fundamental stock picking.
Yeah, that makes sense. Thank you very much. Had a couple of kind of practical questions come in. Somebody's asking if they're available for ISAs and SIPs, which they absolutely are. So these can be held in any kind of tax wrappers. That's fine. In terms of cost as well, there's always interest in how much the ETFs cost on the platform. And correct me if I'm wrong here, guys, but I think the REIs, they vary between 20 basis points and 30 basis points. So that's between 0.2% and 0.3%, depending on which one you go for.
Right.
So we have JURE, which is the US REI ETF, that's 0.2%. We have JGRE, which is the global one, and JERE, the Europe one. They're both 25 basis points, so 0.25%. And then we have JMRE, which is the emerging markets, and that's 0.3%. Okay. Question here about the growth of active ETFs. This is probably one for you, Ted. So we've also seen kind of big explosive growth in active ETFs in the US, partly driven by the tax considerations over there, which aren't so prevalent in Europe. And yet we've seen really strong take up in Europe as well. Why do you think that kind of success has also carried over into Europe?
Yeah, I mean, I think the tax benefit that you get in the US is obviously phenomenal, for those clients, but there are still so many other benefits that come with ETF vehicle for us investors here in the UK and Europe, such as those lower costs that you just went through. I mean, to get active management at 20, 25 basis points, it's incredibly attractive. And so that is a major driver, obviously, of the demand and interest in active ETFs. I think the fact that they're so easy to buy and sell, and not that we expect people or want people to trade these too often, they are long-term investments, but that ability to be able to log onto their InvestEngine account, as you showed in that demo, very easily get access to active management, which traditionally can be quite hard to access, unless you've got a certain amount of money with these low minimums. You only need to buy one share of an ETF. That is the minimum investment. And so it opens up the door to all sorts of investments, as we said. And I think investors just generally, when they use an ETF for the first time, they tend to use ETFs more and more. It's kind of like a snowball effect. And so when we look at sort of industry flows amongst more professional investors, something like year to date, when you look at all the different pooled structures out there, this year alone, 56% of the flow has gone into ETFs, even though they're only kind of an 18% AUM. So investors are increasingly using the ETF vehicle, whether for passive or active. And once they use it once, they like to go back to it. So yeah, what we see it as a growing theme, both on the passive and active side.
Yeah, that's great. Thank you. We've just hit 5:45, so I'm afraid that is just about all we've got time for. I can see there are still a couple of questions that are outstanding. If we haven't answered your question today, then we'll get back to you hopefully over the next few days. You can always email support@investengine.com with your questions, and we'll get back to you that way if you'd like to do that. If you want to find out more about these ETFs, or really any of the JP Morgan ETFs, just click that kind of JP Morgan Asset Management tile that's at the top of the investments page that I was showing you earlier, and you'll find all the details there. Okay, I think all that's left to do now is to say thank you, Ted. Thank you, Rory, for your time today. I think it was a really interesting discussion. And thank you also to everybody who's dialed in for joining. I look forward to seeing you on our next webinar.
Thanks, Andy. Thank you. Take care.
Thanks. Bye.